In a complex market like Forex, we often hear about correlations. But did you know that some of these could do more harm than good to your trading? Today, I will show you which correlations are essential and which could be detrimental to your strategies. Hello and welcome to my channel. I am David, a financial analyst with over 29 years of experience, specializing in currencies and commodities. In this video, I will explore in detail the role of correlations in Forex and how to make the best use of them. Correlation is defined as the relationship between the price movements of two markets. In simple terms, correlated markets have a so-called ripple effect. When one market increases in price, the second market also rises, and vice versa. Often a decline in the first market corresponds to a drop in the second. When we talk about currency correlation, we are referring to the movement of two currency pairs, which may move in tandem, in opposition, or randomly over a given period. Since currencies are traded in pairs, it is impossible for one currency to move without affecting the other. Are correlations important? It depends. In Forex, correlations between currency pairs are not. In fact, they are often detrimental, and I will now explain why. First of all, correlations come and go. This means that today two currency pairs may be correlated, but tomorrow they may not be. By observing correlations across different time frames, you can notice varying values, that is, degrees of correlation, precisely because they are not stable. Therefore, if you set up a strategy based on the degree of correlation between different currency pairs, it is likely that this correlation will suddenly cease, and the worst part is that you will only realize it when you incur losses, with no opportunity to adjust the trade beforehand to rectify the situation. Secondly, it is already difficult to evaluate two economies well. If you add a correlation factor with a third economy, the analysis becomes even more complicated. A statement such as, "If you understand correlations, you can hedge against losses," is blatantly wrong. The most foolish thing to do, for example, if you are long on Euro-US dollar, is to hedge by buying US dollar Swiss franc. You might as well close the position because, in the event of a positive outcome, the loss will remain stable, and in the event of a negative outcome, the loss will increase because the correlation has not worked. However, in Forex, there are essential correlations that every trader should be aware of. I am referring to correlations between currencies and commodities, currencies and stocks, and currencies and bonds. Let me briefly explain their importance and usefulness. Currencies and commodities. You may have heard of commodity currencies, which are the currencies of countries whose economies are heavily dependent on the export of commodities such as oil, precious metals, and agricultural products. These currencies are particularly sensitive to fluctuations in commodity prices, as the export of such goods represents a significant part of the gross domestic product, GDP, of these countries. Among the most traded commodity currencies in the Forex market are the Canadian dollar, the Australian dollar, and the New Zealand dollar. These countries stand out due to their strong dependence on commodity exports, which makes them highly vulnerable to changes in global commodity prices. Unlike other countries that export commodities but have more diversified economies, for Canada, Australia, and New Zealand, commodity exports are vital. This connection makes their currencies closely tied to global economic cycles and particularly influenced by international demand for these resources. Generally, rising commodity prices tend to strengthen the currency of the exporting country, as they lead to increased revenues and an improvement in the trade balance. However, this impact is not always direct and must be evaluated in light of other economic factors, which can either diminish or amplify the influence of commodity price variations on exchange rates. Currencies, in fact, respond to complex economic dynamics that go beyond the simple connection with commodity prices. Among the main elements that can affect these currencies are interest rate differentials, economic growth, fiscal policies, geopolitical factors, and global demand. One of the most closely followed correlations by Forex traders, and not only, is between the Canadian dollar and oil. Canada is one of the largest oil producers in the world, ranking among the top 5 global producers, although it is not part of OPEC. Oil exports represent a crucial component of the Canadian economy, with the energy sector contributing significantly to the country's GDP and trade balance. Another widely followed correlation is between the Australian dollar and gold. Australia is one of the leading global producers and exporters of gold, consistently ranking among the top countries in terms of production volume. Gold represents a significant portion of the country's exports, and fluctuations in the price of this commodity can have a direct and immediate impact on the value of the Australian dollar. A crucial factor to consider is the close economic relationship between countries, such as between China and Australia. Chinese demand for Australian commodities, particularly minerals and energy resources, plays a fundamental role in supporting the Australian economy, and, by extension, the Australian dollar. Fluctuations in Chinese demand can cause significant movements in the Australian dollar, making it essential for traders to closely monitor economic and political conditions in China. Stocks and currencies. Currencies and stock markets are closely interconnected, influencing each other through complex economic and financial dynamics. Although often analyzed separately, understanding how stocks, stock indices, and currencies interact is essential to interpreting the forces that drive the global economy. An integrated approach to these interrelationships is crucial to developing a trading strategy that best exploits the opportunities offered by the synergistic movements between these markets. The relationship between stocks and currencies is based on the interaction between the value of a company's shares, or a market index, and the strength of the currency of the country in which that company or index is based. This interaction is driven by economic mechanisms that cause stock markets to influence currency values, and vice versa. One of the main factors linking stock markets to currencies is the flow of capital, influenced by investors' perception of risk. Funds and investment banks, which manage large sums of money, must constantly allocate capital efficiently, balancing risk and return. During periods of low-risk perception, these players tend to invest in riskier assets with higher potential returns, such as stock markets. Conversely, during times of heightened uncertainty, capital may flow out of stock markets into safer investments like bonds, weakening the currency associated with the stock markets. Capital flows can thus be extremely volatile and reactive to changes in global economic conditions or monetary policies, significantly affecting both currencies and stock markets. However, the relationship between stock markets and currencies is not always linear or predictable. In some economies heavily oriented towards exports, for example, a strong rise in stock markets might coexist with a weaker currency. In such scenarios, a weaker currency can make a country's products more competitive internationally, stimulating exports and indirectly supporting economic growth. Currencies and stock markets are closely interconnected, with dynamics reflecting the interaction between global economies, monetary policies, and investor perceptions. The major global currencies tend to show a direct correlation with their respective stock markets. When the stock market of a given country grows, that country's currency tends to strengthen, as rising stock values attract foreign capital, increasing demand for that currency. However, the US dollar represents an exception to this general rule. Unlike other major currencies, the US dollar often shows an inverse correlation with the S&P 500 futures, as you can see in the chart. The inverse correlation between the US dollar and the S&P 500 is a complex issue. It is primarily a consequence of the dollar's unique role as the world's reserve currency and the economic structure of the United States. Since the dollar is used as a global benchmark, capital flows tend to shift towards the dollar during periods of uncertainty or economic turbulence, causing the currency to appreciate even when the U.S. stock market is under pressure. Understanding these correlations is crucial for traders operating in both the currency and stock markets. For example, if you observe a rapid rise in the S&P 500 accompanied by a stable or strengthening U.S. dollar, this divergence may indicate several possible scenarios. One of these is that the stock market rally may be unsustainable in the long term, suggesting a possible impending reversal in the stock market. Another interpretation could be that investors expect more restrictive monetary policies from the Federal Reserve, which tends to support the dollar's value, but can put pressure on stock prices due to rising financing costs. Similarly, if you notice that the dollar is weakening while the S&P 500 continues to rise, this could reflect increased risk appetite among investors and expectations of accommodative monetary policies. In this context, traders might consider increasing their exposure to riskier assets, expecting further gains in the stock market, while being cautious about long positions on the dollar. By analyzing these relationships between stock markets and currencies in detail, it is possible to identify trading opportunities that exploit specific correlations, as well as divergences that may emerge between stock market and currency behavior. Bonds and currencies. Bond yields play a significant role in determining the direction of a currency. The difference between the bond yield of one country and the bond yield of another country, known as the yield differential, influences the direction of a currency more than the actual bond yield. The yield differential refers to the difference in interest rates offered by bonds from two different countries. For example, if 10-year bonds issued in the United States offer a 3% yield and those issued in Germany offer a 1% yield, the yield differential between these two countries will be 2%. The yield differential between the bond yields of two countries typically moves in parallel with the currency pair in question. A widening yield differential helps strengthen the higher-yielding currency, while a narrowing differential is positive for the lower-yielding currency. Let me give you a concrete example, comparing the yield differential between 10-year Australian bonds and U.S. bonds with the movement of the Australian dollar-US dollar exchange rate. The chart clearly shows how the yield differential influences the currency pair's movement, with the two lines tending to move in parallel. The chart shows that the 10-year yield differential between Australian and U.S. bonds, purple line, fell between January and May 2024. This coincided with a significant drop in the Australian dollar against the U.S. dollar, black line. When the yield differential began to rise again in May 2024, due to multiple interest rate cuts by the Federal Reserve, the Australian dollar-US dollar accelerated its rise, aligning with the yield differential. As with the stock market, by carefully analyzing the relationships between the bond market and currencies, it is possible to identify trading opportunities that exploit specific correlations, as well as divergences that may emerge. In conclusion, while correlations between currency pairs are useless and often harmful, every Forex trader should instead understand the dynamics that govern the correlations between commodities and currencies, stocks and currencies, and bonds and currencies. Thank you for watching this video. I hope the information shared today helps you on your trading journey. Feel free to share your thoughts and feedback in the comments below. If you found this video helpful, please give it a like. To stay updated on my latest videos, make sure to subscribe to the channel and turn on the notification bell. I will see you in the next video.